All right. Good afternoon from Indiana here. We're just getting everybody logged in, so thanks for joining us. We're excited to have you here on this Friday. We appreciate it, whether you're following us through the link. We are broadcasting live on Facebook as well, or possibly just calling in on the phone. So a lot of it will be audio. We do have a couple visuals that we're going to talk about, but hopefully you'll get some great information here today. You can ask questions. We do have some questions that we're going to cover as well, but if you have a question, you want to submit it and you're able to do so, you can do that in the question and answer box, and we'll try to get to that as well. So I am Eric Brenner, President and CEO of Hilltop. If you do not recognize the face or the voice, with me today is Matt Arens, one of our wealth advisors, and we're really pleased to have Joe Mallon with us today. He is from our partner Helios Quantitative Research, and he is the Chief Investment Officer of Helios. If you're a client, you know we work very closely with Helios on an ongoing basis every week to provide us really good data to help make really good investment portfolio decisions. So thank you, Matt. Thank you, Joe, for joining us. I really appreciate it, and I'm going to jump right in. So if you take a look here, we just wanted to share with you. This is now actually a few days old. This is changing pretty rapidly. This week we've had a pretty good little jump up in many of the markets, but you can see a lot of red here. The equity markets on the S&P as of the date of this slide down to just about 20%. Fixed income or bonds down a little over 10% on the U.S. aggregate bond index. And there's just really not a whole lot of place to hide. Markets, there's a lot of red, as we said. I know there's a lot of concern out there as to where we're at. And Joe, I'm just going to open it up to you as a comment, kind of where we're at and, markets and perspective there.
You're right. I mean, is that for me? Sorry.
Yep. Go ahead.
Yep. Sorry. Yeah, there's no hiding from it, right? The start to this year, the first 6 months have been ugly. One of the worst starts to the year for equities ever, and definitely the worst start to a year for fixed income ever. It's rare that you ever see that happen in tandem, but here we are. It's a function really of coming off a really hot 2020, 2021, and a little bit of a reset here from where we were on valuations. And having such high inflation data, the Fed has been forced to really combat a lot of that, which has caused this sell-off both among equities and fixed income.
Yeah, and so talking about that going forward, one of the things we wanted to share, and we have a graphic if you're able to see it. If not, Matt, maybe you can just walk folks through what we're looking at here. We'll go to the next graphic, and is inflation. I think most people that I talk to, they're feeling it in one way or another. Whether that's at the pump or whether that's, at the grocery store or other areas. And we just want to spend some time on inflation and maybe get Joe's thoughts on this.
Sure. I think this really tells the tale of what we're fighting, or what really the Fed is fighting. And to Joe's point, coming off of the 2020 COVID, we're still probably experiencing that. We were talking before the call, it's kind of that the federal government stepped in pretty rapidly in COVID. And sometimes when that happens, you get some superficial pricing when it comes to stocks and valuations. And, we're still struggling with supply chain issues. Some countries still, dealing with COVID itself. And so this has been really the result of it, is just a massive amount of price increases across the board. And oftentimes I think we really experience, one or two areas, but kind of like equities and fixed income, both having rough years. Inflation across the board has really hit every area. We're beginning to see some price drops in certain sectors, certain areas, but as a whole, pretty rapid increase. And that's really what the Fed is trying to fight with raising interest rates. And that's just going to hopefully slow down some of this cost increase. But, you know, like anything else, it doesn't go up overnight. So it'll take a little bit of time to come back down.
Yeah, Joe, do you have, you know, as Helios is looking at this, looking at a lot of different data all the time. What kind of the, you know, the additional comments there based on what Matt has laid out?
I think this just tells a really good story, and a lot of what folks are feeling so far this year. And if you go back prior to 2020, look at the data, and this is what the Fed wants. We want about 2% inflation on prices. The source of that inflation is almost entirely just cost of services. And when you think of what services are, that tends to go towards wages and natural growth and income. But the goods number, which is kind of nothing up until 2020, is flat. That's just, you know, cost of TV and appliances and things like that have been relatively flat, if not gotten cheaper. And then you have things like energy and food, which often are excluded because they're so volatile. And now go to the right and everything's blown up. And I think the energy one, we're all relatively familiar with. We look at the price at the pump. We know that gas or the oil prices have gone incredibly high due to the conflict in Ukraine. Food's gotten more expensive. Goods, I think a lot of this really is supply chain related coming out of 2020. And then services have peaked. So we have this really ugly 9.1% number. But if we play out those narratives and try to give ourselves a reasonable trajectory downward, I think we can play that out. What if energy prices come back down? No more global conflict causing super high prices in oil. What if, you know, food starts to compress? What if supply chain really starts to become fluid? Again, we could see cost of goods not increasing as much. And there's a narrative that can be played out. But like I said, this is a good story, and I think it really puts into context how that number got so high.
Joe, have we seen yet what the Fed has done with the interest rates? Is it a bit too early to see, you know, has it started to curtail it? Where's that at in its kind of process, do you think?
You know, they have a tough job because they knew, and they've always known, that they have to get rates back up to a more normal level. Having rates down at zero was not normal. And it became a policy that probably just lasted way too long. So in looking at this chart in that context, we're sitting back in mid 2021 at 5% readings, and they're going, okay, this is getting a little out of hand. We probably have to raise interest rates 1% or 2%. But as the data continued to climb, oh boy, you know, we now need to be a little bit more aggressive in curtailing this inflation data and try to parse this information as what's naturally going to come down and what's policy actually going to have an effect on in taming the inflation. So they're always going to be behind, and their effects are always going to take several quarters, if not years, to come into, or whatever their actions are going to take several quarters to affect the economy and affect actual prices. So it's hard. Their job is to try to predict this a little bit like we're talking, but create policy around that.
Yeah, so a little bit too early really to kind of tell is yeah, because it's multiple quarters is what
that's right. Yeah, and you have a lot of people calling for, they haven't done this, but a surprise. What if they came out and they raised interest rate 1% and kind of shocked the market? And that's where a lot of economists think that might be a good thing. That might be the one mechanism that could put a little bit of, you know, lighter fluid into reducing inflation. Because right now everything's based upon the expectation of what their action is going to be.
Yeah. Well, and then we look at the expectation. So still around this inflation, and you know, I know you provide us with a lot of information and a lot of information around the discussion on rates and all of that. So maybe just share with us what we're looking at here and you know, what may be or may not be, but at least gives us kind of a forward-looking thinking.
Yeah, so this is a chart that shows along the bottom there, the Fed's forward meeting dates. And then the boxes represent the odds of where the Fed funds rate will be as a result of that meeting. So for example, we're seeing here an 80% chance that their target rate will be between 2.25 and 2.5, which would equate to a 75 basis point hike at that meeting. And the reason this data is important, it's market driven. There's actual markets that have probability of Fed forward rates. So this is the story of what the Fed's projected path is between now and March of next year. And this is what I believe the markets are pricing in. So it's not what they do that really matters. It's what are the markets expecting the Fed to do. And if this expectation changes, that's how markets will react, both bond markets and stock markets.
And you get back to what you had said, kind of shouldn't be zero. It can be something other than zero, right?
And that's where, it's painful sometimes to go from zero up, as helpful as it is to go from 3-4% down to zero. Going 3-4% down to zero is stimulative. They did that coming out of the recession in 2008, and it was warranted, right? It got the economy back on foot. But when times are healthy, or when you have good economic data, is when you want to actually raise this rate.
Yeah.
This has just happened in a very scrunched up time period. Usually it's a path over a few years in which we expect Fed to get up to a more normalized level. We're going to deal with that in probably a 12-month period.
Yeah, it's good. Thanks for that. And then, so overall on the inflation number, so we go from where the rates are to inflation. So Matt, we've got this next graphic, and then we'll talk a little bit more about inflation and kind of move on to a bit more specific on asset classes and so forth. But I think this is good. We use this a lot, I know, with our client interactions, but you want to go over that, and yourself or Joe has some comments on this.
So this is really just, I think, forecasting kind of just the previous slide. And I think this is to Joe's point, is, getting rates normalized within that 12-month scrunched period. The Fed's expectation would be then, because of that rapid increase, we would see inflation really curtail pretty quickly, hopefully by Q2 of next year, and get back to really normal rates. I mean, there really wasn't much, you go back a couple slides of that inflationary expense, you really didn't feel the crunch on anything movement wise overall. I mean, inflation was very flat, very stagnant. For years, you could buy a pair of shoes at the exact same cost. And I think you still have that area or that component in some areas of the market. But as a whole, the thought would be the Fed's real goal is to get rates back down to normalization. And you would see that by next year with the moves that they're making. And, could be faster if they do shock the market, could be a little slower if you have some unforeseen events get thrown in there. But as a whole right now, this is really kind of the glide path that they're on.
Yeah, and this is really that story going back, from a couple slides ago, where we want inflation data to go. And this again is a market-driven analysis. So this is a survey of really the top economists that spend all day projecting where inflation data is going to be. So this is an important part of the Fed's mentality to say, man, we don't want to raise rates so fast, chasing, like Eric said, chasing that 9.1% number, because by the time we get there, we might already be falling down here, and we got to correct ourselves. So This is where they're very cautious in their policy and the timing, and almost more so the narrative, the projection of what they're going to do, because they want to keep all of this into context and follow it at a you hear that term, soft landing. That's a lot of what they're focused on with their rate policy right now. They don't want to raise rates too much that it starts to actually push these growth numbers or the inflation numbers negative.
Joe, do you, I hear a lot about I mean, recession, obviously, are we in one? Are we coming to one? You know, I know, you had indicated prior that, you know, if we do have a recession, and this may be the first one, right, with this low unemployment, kind of how you see in the data and recession and probability and of a recession, in all of this in the coming months.
The first thing's an interesting point. I don't think many folks know this. I certainly didn't until a few years ago, but there's no perfect definition to a recession. So loosely, it is 2 quarters of negative economic growth or negative GDP growth. There's actually a board, the NBER, that determines, you know, with a stroke of a wand, whether we're in a recession or not. So they look at other factors. So this time period, and I'll get to it in a second, is very different. And the three of us talked about this for quite a while earlier, that when we traditionally think of a recession going back 20, 30 years, we have a market cycle. We have expansion for a few years, we hit a top, we have a contraction, then we hit this nasty thing called a recession for a few quarters, and then we continue on with that cycle. This happened in 2000, 2001, 2008. We flirted with it in 2015, 2016, and then 2020 came. And this really threw a wrench, in my opinion, to everything economically related. And we had such negative growth, followed by such positive growth, that effect is really kind of settling down, in my opinion, here. So I think a recession is inevitable. And I would argue it doesn't really matter. Does it matter that this board decided that we're in a recession or not? I think the underlying data is what matters more. And just coming to an acceptance that the world's a little bit different coming out of 2020. And we shouldn't expect things to be as rudimentary as they've been historically as a result. So we could have this recession in late 2020. We could be in a recession now. We could be in a recession later this year. What we do have really positive things happening, like the jobs picture is still very strong. There's more job openings than there are people to fill those seats. The retail sales are still very strong. You're not seeing a lot of this economic data that almost always happens when we have a recessionary environment.
Yeah, it's good.
Yeah, and I think Eric, you know, the other point is that I've been trying to stress is it almost feels good that the government isn't coming in and just printing a bunch of money to control, you know, markets and recession feelings like they did, or, you know, arguably maybe had to do in 08, 09, even 2020. You know, they were just flooding the market with money. And I think it really just became difficult in that time period for analysts to really determine what is an appropriate stock valuation, or the market and investors to determine what's an appropriate valuation. And we're not seeing that as of now. They're trying to control it with more normal interest rate movements, as opposed to just flooding the market with money, which I think for us is saying, hey, there's confidence in the government that the economy itself is actually doing quite well. And the market will kind of reflect that along the way. But it'll also provide, I think, more realistic growth long term, as opposed to these huge peaks and troughs based on superficial data, because the government's intervention is always there.
Yeah, it's definitely a great point. So I'd like to shift a little bit and talk about a little bit more asset class related, maybe talk sectors, things like that. So certainly the bond, we looked at the performance, and people, if they own bonds, they know, you know, they've taken a hit. And so Joe, you know, one of the questions we had submitted was expectations of bonds going forward, you know, more conservative portfolios, more in that fixed income. How should they think about it, you know, moving forward?
Yeah, this is probably the number one question we get now from advisors, and it makes a ton of sense to me. If you're a conservative investor, I don't think your expectation was that bonds could ever be down 10% in a 6-month period. But it happened, and it happened because rates went up so fast. Typically, rates go up in a slower pattern, but they are also haven't historically gone up from a level of 0. So I like to just have people think a little bit of where we were, call it a year and a half ago. And that's where you had a super high quality, low risk bond portfolio making what, 0.5% to 1% in a year. And everyone's going, this is awful. You know, how am I going to meet my income needs with really low yields on my bond portfolio? And if we ignore really what's happened over the past year and a half, I know it's tough to do. We're now looking at those portfolios earning 3.5%, 4%. And I think that's a much more palatable figure to have going forward, to get this higher yield. The pain to get there was a little bit of a mark to market loss in those bonds, but they should make you more and recover that loss over time. So that's the reality. And what do you do about it? And I think our research has shown, and I don't know, you guys have done a lot of these preservation moves too. And that's, let's take less interest rate risk. Let's lower our what's called duration in the portfolio. Not do anything drastic. Let's not, just run away from the market. But let's be conservative throughout this period of time. Let's avoid some high yield and corporate bond exposure and go more treasuries and try to soften that blow. And now on the way up and looking forward, we can be more opportunistic and look back to getting those into those asset classes when the time's appropriate.
Yeah, that's great. And along those lines, I think that a lot of times, especially when we get into this market volatility, it appears, we've had questions and had a question submitted. It appears that maybe, changes aren't happening quick enough. I know we have very specific calculation points that we get data from you, and we analyze it and then implement it in our portfolios. But either Matt or Joe, you want to just comment on, we certainly don't want to day trade, right, Joe? I mean, there's that fine line, but again, when there's volatility, it feels like, well, maybe there should be more changes quicker, but you just got to draw that line somewhere. It's a fine line.
Yeah, and we all know this, and there's a lot of behavioral factors of just human beings, of hindsight bias and wanting to be right all the time. And we have to really revert back to our core principles of looking at lots of data, not letting one decision drive our thought. So when we're looking at market data, we're looking at a lot of things. We're looking at the economy. We're looking at the trend in the overall market. We're looking at the projected volatility. We're looking short-term opportunistic in sectors, and kind of manifesting all of this data into decision-making within a portfolio. And what that means is not allowing our emotion to drive our decision, to follow this quantitative process, to have justification, and to accept the fact no one ever will be right 100% of the time. And how do you define what that time frame is? Is it weekly? Is it daily? Is it monthly? Is it annually? We don't know. But what we want to do is make smart decisions that can provide, ideally, a better result than it had you not made them. And that's what we want to do. And we look to make decisions once or twice a month. We don't want to be too knee-jerk reaction. We still want to have a long-term focus on our portfolios. And that's a lot of what we've done, paring back equity exposure earlier this year, not trying to be too quick to do it. Understanding that the economy is getting soft and maybe we want to take a defensive position, overweighting things like the US relative to international, flipping into value. There's so many different thoughts that manifest into the end portfolio, that many of those decisions are right at one point, many of those decisions are wrong, but we think, taking those decisions, and if more of them are right than wrong over time, you'll have a better outcome.
Great. Thanks for that. Matt, I know you had a couple questions around, you've been receiving questions around, sectors, one, and then the geopolitical kind of environment and how that might look or affect. I think you wanted to You got a couple questions for Joe.
Yeah, so just Joe, maybe if you want to, clarify for everybody, just when we break down sectors and determine we need to be in these two sectors, at this time period or not, really just what's the rationale on why specific sectors? Is it opportunistic? Is it based on valuations? Is it based on trend? What kind of really drives when to be in sectors and when not to be in sectors?
It's simply put a trend view of sectors. So we look at the 11 major sectors in the S&P and say what prices are trending positive at this point in time, which two are the leading, and those are the two that we're going to own. And you said something really important there, and it's not, this is a quantitative process where if you rotate into these sectors over time that are trending the most, it has shown over 20, 30 years of data to provide value over just owning the S&P 500. And again, it doesn't mean it's perfect. Don't extrapolate that thought of this quantitative process to, Joe Mallon and Helios thinks energy is the best place to be over the next 30 calendar days. No, it's a quantitative process by where rotating into these sectors has proven to really capture that behavioral trend of markets. People tend to flow into the things that have this recent bias of outperformance, and that's what this method is really looking to do. So it's a great question, and that's really how our data approaches investing in sectors. And that can be met with skepticism a lot, because we get that question of, hey, Joe, what's the one sector I need to own for the next 2 months? And I have such a hard time saying that, because I go, are the markets going to go up or down? Because if the markets are going to go up, I can tell you probably what sectors are going to lead it. If the markets are going to go down, I can tell you probably what sectors are going to lead it. So it's independent of the direction of the market. And it's all about risk management and portfolio construction and looking at the very big picture. Don't take one of those picks as this is the hottest place to be for the next 30 days, because that is not how the strategy is designed.
Right.
Yeah. Matt, you want to ask the other question you had come in about the geopolitical, and then I've got another question that came in.
Sure. Yeah. Just, it seems like oftentimes when you have elections or midterms, the government or anybody looking to get reelected is really trying to push some things through. And, I think Americans are pretty short-lived on memory oftentimes. And so sometimes we feel like maybe they wait till they're closer to election times to make decisions to get people and voters to rally. Do you see anything coming down at this point that says we'll probably see some moves here or there based on what the government is viewing as opportunistic for market rallies?
Honestly, no. And we've done a lot of work on this, right? And investors, people tend to be very political, emotional. We deal with this going into every election cycle, and politics aside, it's usually a narrative of, if my party doesn't win, the world's going to fall apart and the markets are going to crash. And that's what we want to believe, because that's what, if we don't get our way, we want that to be what happens. And it's a tough pill to swallow, to tell people this sometimes, that, the world isn't going to end. The economy isn't driven. It's driven far more by innovation and things like that than who's in political office. That being said, there are some things that matter. Taxes matter. Taxes stymie growth. And there are things that do have an impact. But I don't think it's enough to make very, significant decisions in your investment thesis. There tends to be a little bit of choppiness around news here or there. But what's more important in a portfolio is the overall growth of the economy, growth of companies, not so much very short-term political policy. So, and the reality, you can put blame on politicians here and there for certain events. You can find data to help support it. It's just, we've done the research, and over the long term, there isn't a lot of data there to really support that politics significantly impact the outcome of stock markets.
Yeah, great. Thanks, Joe. You know, we had a question around, you know, what does history show a time frame that maybe investors can kind of get back to kind of where we were prior to this downturn, not even considering growth. You know, I do say that with, you look at the S&P 500, even 10-year average is still 12.9%. So even with what we've had, and what I know is oftentimes, you know, including myself, you think of the high water mark that you hit, right? You don't look at it longer term. And of course, if you know, we have a lot of our clients that are taking money as well. So, but just, you know, when you look historically, kind of getting back to where we were, again, not really growing even, you know, just getting back and kind of recouping where we're at. How do you think about that?
That it's a great question, and one. I love the way the question was phrased as to what might we expect based upon the data, and based upon our recent memory, I think all of our feeling is let's buy this dip and we'll be back to new all-time highs quickly, right? We go back to 2020. That was I don't know if anyone remembers how they felt in March and April and May of 2020. It was not good. It was, but we got back to new all-time highs quickly. And going back to the winter of 2018, I don't know if you remember that, October, November, December, and we bottomed on Christmas Eve, down 20% from all-time highs. And this was the Chinese tariffs, Fed raising interest rates, growth concerns. We were down 20%. We rallied back within 3 months. Then we go back to 08, 09. It was a drawdown of close to 50%, but we recovered within about a year. Okay. So here's 3 data points, recent memory of, okay, we're down 20% right now, Joe. We got to buy in. We're going to be back up to all-time highs by the end of the year. I would counteract and caution that feeling with what happened in 2000, 2001, and 2002. That was the tech bubble bursting coming out of the late 90s. We had 3 consecutive negative years in the S&P, and they were very choppy. We had some very good months within that 3-year period of up 8, 9, 10%. But we continued to kind of chop sideways and downwards. So it's hard to project, but Matt and Eric and I were talking about this, that, and Matt mentioned it, absent Fed intervention and government stimulus, those were the things that really propped up those last 3 quick comebacks. Do we think that we have the appetite for that to happen in a quick manner this time around? I don't know. I think the probability is much less than it was over these last 3 cycles. So I just say all of this to put a counter data point that this just has to snap back. This has to mean that we're at new all-time highs just because. It takes a lot to be able to do that. And I don't know if the recipe is the same this time around.
So it might be longer versus snapback of recent memory. Might be a bit longer.
We've seen it this week. I mean, if anyone's been following the markets going back the past 5 or 6 days, the NASDAQ rallied, I think 7, 8, 9% in a week, but it's down 1.5%, 2% today. Markets are volatile, and they've been shown to do this for a long period of time. And it's not normal to have 12, 15% returns in equities like clockwork. Yeah. Sometimes it's a rough ride to get to that 7, 8% annually that history's shown.
Good, thanks, Joe. Just a couple quick other questions I want to get to. We don't want to go too much longer because I know people want to move on with this beautiful Friday. But so Matt, question was around what to do if you have kind of cash or excess cash. You know, I know we want to tie it to financial goals and what is it meant for. You know, CD rates and so forth for short terms looking a little better. So you just want to address that question, please?
Sure. I think, you know, if you really want to maintain just kind of more core principal preservation, I think there's great opportunity in short-term CDs, even less than a year. You know, we're able to get around 3% yield on those, which I think is great, better than the getting paid nothing in your bank. I think even short-term bonds, we're seeing 3-4% yields on that with little price movement as most of those interest rate movements are already priced into the market, which is good. If it is money for longer term goals, I think, there is the market could continue to go down, but I do think there's a massive amount of validity to say it is a 20% decrease in price valuation. So that's better than buying, something at its all-time high. So I think those types of moves, you really just have to define what the money is for based on time horizon, and then make the appropriate decisions from there. But I do think that there is good short-term money and interest rates that can be made outside of a savings account.
Great. Yeah. And then if it's for longer term, a strategy of starting to dollar cost average in, something along those lines might be
Right.
good for their overall financial plan, but really tying that back in. So thanks, Matt. And then I just want to get to Joe quickly. People talk about supply chain and supply, and we talked about it a little bit, but data there's, I don't know, you didn't use the word small little signs, but a few things there that may be slightly improving.
Yeah, there's some evidence that things are getting a lot better. And there's some micro data you can look at, like the number of ships in Long Beach's port, or one that's interesting, the cost to ship a container from Shanghai to California has fallen quite a bit. And that's just evidence that there's more supply here of ships and movement than there was, call it a year ago. And the kind of COVID lockdowns in China are more regional, but those have largely, it could get worse again, but have largely lifted. And even today, I saw it pop up on my phone maybe an hour or so ago that one of Ukraine's ports is now going to be open to allow wheat to be leaving the country again. So there's a lot that has impaired the supply chain coming out of COVID and with geopolitical conflict and continued COVID health concerns. But we're seeing signs of softening there. And hopefully that's good for the inflation data, especially in that goods bar that we saw on that chart.
Great. Thank you. Well, you know what? The three of us could chat all day on this stuff, but we're gonna wrap it up here. And I just want to thank Matt and Joe, especially. Thank you, Joe, for joining us and sharing kind of a lot of great information. And we want to thank everybody that's out there, whether you're on the phone or Facebook or following us live. We will send out a link. This will be recorded, obviously, and we'll send out a link. And from the entire advisor team, if you're a client, we want to thank you for allowing us to kind of guide you along your financial journey. Our commitment to you is to continue to make sure that people are on track for their financial goals. And the investment part of it is a piece of it. And with the assistance of all the information Joe and his team provide to us, it's data-driven investment decisions. So thank you, guys. I appreciate it. I appreciate the time. We will continue to communicate. We'll probably have more of these as we move forward here this year. And with that, I will say so long till next time.
Thanks, everyone.
Thanks.